The fair value gap and order block strategy is one of the most solid approaches within smart money concepts right now. The reason is straightforward. It shows you exactly where institutional money was positioned in the market, where price is likely to return to seek liquidity, and what the high probability entry point looks like before a real directional move happens. We are not talking about indicators or moving averages. We are talking about market logic, how the big players operate, how they collect liquidity, how they create imbalance, and how you can position yourself alongside that flow instead of against it. If you have never heard of fair value gap or order block, this video was made for you to start from zero and finish understanding the full system. And if you already know these concepts but still struggle to trade them consistently, what you are about to see here will close the gaps that are stopping you from executing these setups with confidence. So let's get straight into it. But before we get into the fair value gap itself, you need to understand the foundation of SMC, how the market actually moves. Without that foundation, the fair value gap becomes just another visual pattern you recognize on the chart without truly understanding what it represents. And that is where the problems start. You see an FVG, you enter the trade, price comes back, tests the zone, and you are left wondering, does this confirm or not? Is it still valid? Did it just invalidate? Those questions disappear once you understand the logic underneath the concept. So let's start here. Within SMC, the market is not random. It follows a logic of liquidity seeking and price delivery. Before any strong directional move up or down, the market needs fuel. That fuel is the orders sitting on both sides of the market. The stops of buyers who got trapped at a top, the stops of sellers who got trapped at a bottom. Those orders are the liquidity the market will seek before it actually moves. Understanding this changes the way you read every chart you look at. Think of the market as a two-step process. First it goes after the orders, then it delivers the real move. That sequence repeats across every time frame, from the 1-minute chart all the way up to the weekly. The scale of the move changes, and the volume of orders involved changes, but the logic is always the same. Once you start seeing the market this way, fake-outs stop surprising you, stop hunts make sense, and moves that used to look random start looking intentional. The market was simply collecting fuel before moving, so when you see price rising toward a previous high, inside SMC, you do not think I'll buy the breakout. You think the market is going after the liquidity sitting above that high, the stops of the short sellers who placed their stop above the previous peak. That is what we call buy-side liquidity. And the opposite, the stops of buyers sitting below a previous low, is sell-side liquidity. The market is drawn to those order pools. And it is exactly in that collection process that fair value gaps and order blocks become relevant. A practical example to make this concrete, imagine you are looking at a 1-hour chart of a currency pair. Price has formed 3 consecutive tops in the same area, all rejected, all closing below the same level. Traditional technical analysis traders call that resistance and sell short with a stop above the zone. Inside SMC, you look at that same formation and think differently. There is a large concentration of stops sitting above that level. The market will likely push up there, trigger those stops, and then fall for real. That is buy-side liquidity being collected before a bearish move. And when you understand that, you are no longer selling into resistance alongside everyone else. You are waiting for the sweep of that resistance to sell afterward at a much better location. Now let's get into the fair value gap, which is the most visual concept in SMC and the easiest to identify on the chart once you know what you are looking for. The FVG is a price imbalance zone. It forms when the market moves with enough force and speed in one direction that it leaves a gap between 3 consecutive candles. The lower wick of the first candle does not reach the upper wick of the third candle. That open space in the middle is the fair value gap. It is a zone where virtually no transactions occurred because price moved through it too fast for there to be any equilibrium between buyers and sellers. Why does that matter? The market tends to return to fill those zones. Not always, and not necessarily all the way through, but there is an attraction of price back toward them because that is where the institutional orders that started the move need to be completed. When an institution enters a large buy order and creates an impulsive move upward, some of those orders were not filled at the ideal price. So when price returns to that zone, those pending orders get filled, and that is where the market finds genuine support or resistance. To visualize this on the chart, pay attention to the following. You will see price moving calmly with candles of similar size, and then suddenly a large candle appears, near full body, moving in a single direction with speed. That candle, plus the candle before it and the candle after it, form the 3-candle sequence. The fair value gap sits between the lower wick of the first candle and the upper wick of the third. If the move was bullish, the FVG sits below current price. If it was bearish, it sits above. In both cases, price will likely return to that zone at some point before continuing in the direction of the original move. What you will see after is this. Price makes an impulsive move, creates the FVG across those 3 candles, continues up or down, and at some point pulls back to test that zone. That pullback is where the setup forms. The mistake most traders make is entering the moment price touches the FVG. No confirmation, no confluence check, no verification that the zone is still valid. They just see price arriving at the zone and they open the trade. When the market continues straight through the FVG without any reaction, they end up stuck in the wrong side. And this happens far more often than people realize. A new trader learns the FVG concept, goes to the chart, marks every zone they can find, and starts trading each one. Sometimes it works. Sometimes price blows through. The frustration builds when they cannot tell the difference between an FVG that is going to hold and one that is going to get mitigated. The answer lies in filters, and that is what we are going to cover now. Not every fair value gap is going to hold price. Some FVGs get mitigated. Price moves through them without any reaction, and the reason is usually that the broader context is not aligned. Price might be in a downtrend, the FVG might be bullish, and you buy expecting a reversal when in reality the market is just going to keep falling. That is trading against structure, and it is the most common mistake among traders who are new to FVGs. The validity of a fair value gap is directly tied to the context in which it was created, the direction of the higher time frame trend, and what is happening with market structure around it. How do you filter the FVGs that actually matter? The first filter is structure. You need to be trading fair value gaps that are aligned with the trend on the time frame above. If on the daily chart the market is in an uptrend, forming clear higher highs and higher lows, then you are going to trade bullish FVGs on the 4-hour or 1-hour chart. You are not going to look for bearish FVGs to sell in a market that is structurally bullish on the daily. That time frame alignment is what separates the trader who operates SMC consistently from the trader who trades every FVG that shows up. In practice, this means before you mark any FVG, you start from the highest time frame. You look at the weekly and ask, what is the dominant trend? Then you go to the daily and ask the same thing, then the 4-hour. Only then do you drop to the entry time frame, usually 1 hour or 15 minutes, to find the FVG you are going to use in the trade. When all those time frames are pointing in the same direction, setups have a significantly higher rate of success. When you are trading against one of the higher time frames, the probability of getting mitigated goes up considerably. The second filter is the origin of the FVG. Was the move that created the zone impulsive, or was it weak? A fair value gap created by a displacement, that large, near full body candle that breaks an important level with force, carries far more weight than an FVG created by any random sequence of 3 average candles with no context. Displacement signals institutional intent behind the move. When price creates a fair value gap in the middle of a displacement, that zone carries the weight of the orders that started the move. That is the type of FVG you want to be trading. A weak FVG, on the other hand, is one created by 3 average-sized candles with no large body, no important level broken, and no structural change associated with it. That type of FVG can be tested and mitigated without any reaction, because there are not enough institutional orders in that zone to sustain a rejection. The practical rule is, the larger and more aggressive the move that created the FVG, the more relevant that zone is going to be for future trades. A context that amplifies the relevance of an FVG even further is when it was created during a high volume session, the New York Open, the London Open, or the overlap between the two. During those periods, institutional volume is at its peak, moves are more aggressive, displacements are more impulsive, and the imbalance zones created during those windows carry more weight than ones created during low liquidity hours, like the tail end of the Asian session. If you compare an FVG created at the London Open by a displacement that broke a significant level versus an FVG created at 3 a.m. during the Asian session, the difference in relevance is clear. The first one has a much stronger chance of holding as a support or resistance zone, so whenever possible, prioritize FVGs created during high volume sessions. They reflect real institutional intent, not low liquidity noise. The third filter is the size of the FVG. Very small fair value gap zones, just a few pips or points between the wicks, tend to be less reliable because the level of precision required to trade them is too high. A small variation in entry already puts you outside the zone. The FVGs with more relevance are those with a reasonable depth, giving price room to touch and react within the zone without you needing to nail the exact entry point. A good approach is to enter at the top of the FVG, the beginning of the zone as price returns to it, and place your stop beyond the far end of the zone so you are positioned inside the imbalance, not in front of it. Now let's bring in the order block, which is the concept that works alongside the fair value gap and significantly increases the probability of your trades. The order block is the last candle moving in the opposite direction before an impulsive move. In practice, if the market was falling and then creates a strong bullish move with displacement, the last bearish candle before that move, the red candle that preceded the impulse, is your bullish order block. That is where the institutions place their buy orders before pushing the market higher. The logic is straightforward. Institutions cannot enter a large position all at once without moving the market against themselves, so they accumulate over time in specific zones using the available liquidity at those levels. Once the accumulation is complete, they execute the directional move, which is what you see as displacement on the chart. And the last candle before that move is the record of the accumulation, the point where the orders were placed. When price returns to that zone later, institutions are coming back to complete what they started or to add more to their position at the same level. That is why order blocks work as genuine support or resistance. On the chart, you identify the order block like this. Look for a clear impulsive move, that displacement with large, full-body candles moving with speed in one direction. Then look at the candle immediately before that move. If the move was bullish, the candle before it is likely bearish. That bearish candle is your bullish order block. The zone runs from the open to the close of that candle's body, and that is the range you mark on the chart as your area of interest for entries. Something a lot of traders confuse is the difference between the body and the wicks of the order block. The relevant zone is the body, when from the open to the close of the candle. The wicks are not part of the zone definition. When price returns to the order block, you want to see it entering the candle body, not just touching the lower wick. If price touches only the lower wick of a bearish candle and reverses, that can be a valid rejection, but it is not technically the order block zone. The distinction matters because your entry level and your stop are going to be based on the body boundaries, not the wicks. Another important point is that the most relevant order block is always the most recent one. If the market created several order blocks in the same direction across a move, the one with the most weight is the last one, the closest to current price. Older order blocks get consumed over time by intermediate price moves, and their effectiveness decreases. When you are looking for an order block to trade, always start with the most recent one and only move to older ones if the most recent has already been mitigated. What happens when the FVG and the order block are sitting in the same zone? That is confluence inside SMC, and that is the type of setup you want to prioritize. When price creates an impulsive bullish move, leaves a fair value gap in that sequence, and the bottom of that FVG sits inside the range of the order block that preceded the move, you have a double zone of interest. Price will return to that area because of the natural pull of the FVG, but when it gets there, it will meet the support of the order block at where the institutional orders are positioned. Both zones at the same level create the highest probability setup within smart money concepts. When you are analyzing a chart and find this overlap, what you see visually is a price region that concentrates both elements at the same time. The order block zone is there, and inside or very close to it sits the FVG created by the displacement that followed. When price returns to that area, the probability of a rejection is higher because there are two institutional factors active at the same level. That is the type of zone you want to identify first every time you open a chart. The most important detail in the entire system, the entry does not happen when price touches the zone. The entry happens after confirmation. That confirmation is the market structure shift on the lower time frame. When price returns to the order block or the FVG and starts showing signs of reversal, forms a higher high on the 5 or 15-minute chart, shows a strong rejection candle, or breaks a minor bearish structure that formed during the pullback, that is when you have the signal to enter. The market structure shift on the lower time frame is what confirms the zone is actually holding price. Without it, you are entering on hope. With it, you are entering with evidence that the market has already started to reverse at that point. The difference in win rate between entering with and without the MSS is significant. Traders who wait for the MSS on the 5-minute chart before entering an order block on the 4-hour are operating with far more precision than those who enter the moment price touches the zone. Without that confirmation, you are not trading SMC, you are guessing. Price can reach the order block and the FVG and continue falling without any reaction. When that happens, you need to recognize the invalidation quickly. A bullish order block is invalidated when price closes below the body of the candle that defines it, especially when it does so with an impulsive bearish candle. At that point, the zone has lost its meaning and the analysis needs to be revisited. The invalidation of a fair value gap happens when price moves completely through it, from the top to the bottom of the imbalance, without any reaction. That does not mean the next FVG in the direction of the trend will not work. It means that specific FVG has been mitigated and no longer has relevance for the trade you are building. Recognizing that and stepping aside without hesitation is what separates the disciplined trader from the one who holds losing positions waiting for the market to come back. A concrete scenario to illustrate this. You are trading a bullish FVG on the 1-hour chart. Price returns to the zone and instead of rejecting, closes inside the FVG with a bearish candle. You do not invalidate yet. Price then forms another bearish candle, closing below the FVG entirely. Now the zone has been mitigated. At this point, the analysis you built is no longer valid. Disciplined traders exit here, whether via stop or manually, and move on to the next opportunity. Undisciplined traders stay in, widen the stop, and turn a small loss into a large one. Invalidation is not optional inside SMC. It is part of the process. Now let's connect these concepts with the third pillar of the system, liquidity. Every time the market forms a clear top or a clear bottom, especially one that has been tested more than once, there is a concentration of orders above or below that level. Above equal highs sit the stops of short sellers and the buy stop orders of breakout traders. Below equal lows sit the stops of buyers. Those concentrations are liquidity pools, and the market is drawn to them before any major directional move. The most relevant liquidity pools to watch are equal highs and equal lows. Those areas where price formed two or more tops or bottoms very close to one another. When you see that formation, you know there is a high density of orders sitting there, and you know the market will likely move to that area before reversing in the opposite direction. This is not a random prediction. It is the logic of how the market needs fuel to move. And equal highs and equal lows are the most visible fuel tanks on any chart. Beyond equal highs and equal lows, other liquidity pools worth paying attention to are the previous swing highs and swing lows that have been established as reference points for a long time. When price forms a significant top in 1 week, and that top remains untouched for weeks or months, the concentration of stops above that level grows over time. Every trader who sells into that resistance during the following weeks places their stop above that high. When the market finally goes for that level, the amount of orders collected is substantial, and the move that follows the sweep tends to be proportional to the amount of liquidity collected. That is why older liquidity pools, the ones that have been untouched for longer, tend to produce the most significant moves after the sweep. In practice, when you identify a liquidity pool on, say, a region of equal highs on the chart, you know the market will likely push up to that level to do the liquidity sweep, collect the stops sitting above those equal tops, and only then show its real direction. And what happens right after that sweep is the most useful moment. If the bullish move turns out to be bearish, if the market went above the equal highs only to collect stops and then reverse lower, what you will see on the chart is a strong bearish displacement candle right after the sweep. That candle will create a fair value gap and leave an order block at the turning point, and then the cycle starts over, this time moving toward the sell side liquidity below previous lows. When you look at a chart through this lens, market structure, liquidity pools, fair value gap, order block, confluence, you start reading the market as a process with defined steps. Every move has a reason, every zone has a logic, and when you can identify which step of the process the market is in, you can anticipate what comes next with a level of precision that standard indicators simply cannot offer. And that brings us to the concept of change of character, or CHOCH, which is the first confirmation that structure is shifting when the market is in a downtrend and consistently forming lower highs and lower lows, and then suddenly breaks the last lower high impulsively with a displacement candle. That is the CHOCH. It is the signal that the direction of the move is changing. The downtrend was interrupted by a structural break with force, indicating that the bias has started shifting from bearish to bullish. At that point, you do not buy immediately. The CHOCH alone is not the entry, and it is the confirmation that the bias has changed. What you do is mark the fair value gap created by that displacement, identify the order block that originated the bullish move, and then wait for the pullback to that zone. When price returns to the FVG and order block after the CHOCH, and you see the market structure shift on the lower time frame confirming the reversal, that is when you have the complete setup to go long. The full sequence is collection of sell-side liquidity below previous lows, bullish displacement creating the CHOCH, formation of FVG and order block, pullback to the confluence zone, MSS confirmation on the lower time frame, entry. When you see all those pieces together, and you will learn to identify each of them with practice, the probability of the trade working is significantly higher than when you enter any FVG without the other elements present. Each element you add to the analysis is one more filter that raises the quality of the setup. An important detail about pullback timing: price does not always return immediately to the order block or fair value gap. In some cases, the market continues moving up or down depending on the bias for several more candles before pulling back. This is especially common when the displacement was very strong, when price broke through multiple resistance levels at once, or when there was a large amount of buy-side liquidity above the turning point. In those cases, the pullback can take hours or even days to develop. A lot of traders make the mistake of chasing price in those moments. They see the market moving up after the CHOCH without returning to the zone. They get anxious and they enter a random trade to avoid missing the move. Then when price finally pulls back, as it always does at some point, they are stuck in a position with no clear stop, no defined invalidation zone, and no SMC logic underneath the entry. The rule is simple: if price did not return to your zone of interest, you do not trade that swing. You wait for the next one. The market will create more opportunities. It always does. There is another scenario you need to know about: the breaker block. It forms when a bullish order block is violated. Price falls through it and invalidates the zone, and then the market returns to test that level a second time. When that happens, what was previously support now acts as resistance. The logic is that the institutional orders sitting in that zone as buys were stopped out when price violated it. The traders who were long in that order block exited with a loss. And now when the market returns to that level, those same traders are willing to sell at the same price where they took a loss earlier, just to break even. So that is where sell orders concentrate. This is the structure flip applied to order block zones. On the chart, the breaker block works like this. Price had a bullish order block marked between 100 and 102. Price then dropped below 100 with an impulsive bearish candle, invalidating the zone. The buyers positioned in that order block got stopped out. Then the market bounced back up to the 100 to 102 area. That return is the selling opportunity, because the zone that previously had buy orders now has sell orders, both institutional orders and retail traders looking to recover their earlier loss. The breaker block is one of the most precise setups in SMC because the market behavior logic behind it is clear. To confirm a breaker block, the validation process is the same one you use for a standard order block. You want to see price return to the zone, and you want to wait for the lower time frame structural confirmation before entering short. A strong rejection candle in the breaker block zone, followed by a lower low forming on the 5 or 15-minute chart, is the confirmation you are looking for. Without that confirmation, price might just be consolidating at that level before breaking higher, and you would be selling in the wrong spot. Connecting all of this, we also have the mitigation block, which is slightly different from the breaker. The mitigation block forms when the market creates an order block, but before returning to that zone a second time, price already had a partial reaction from it. That means the zone was partially tested and produced a reaction, but not enough to be considered fully mitigated. The zone still has relevance, but the strength of the support or resistance has been partially consumed. Think of it this way: a virgin order block, one that has never been touched since it was created, has all its institutional energy intact. A mitigation block has already been tested once, so some of those orders have already been filled, and the remaining energy is lower. In practice, this means that when you are comparing a mitigation block to a virgin order block, the virgin order block will have a simpler confirmation requirement and a higher probability of working. The mitigation block still functions as an entry zone, but you need a clearer confirmation before entering because the zone's efficiency is lower. If a single rejection candle with a long wick is enough to confirm the virgin order block, at a mitigation block you want to see the full MSS on the lower time frame before opening the position. One concept that ties all of these together is premium and discount. Within SMC, the market is divided into two zones using the 50% level of the last swing. From the last high to the last low, above the 50% is the premium, below it is the discount. The basic rule is to buy in the discount and sell in the premium. If you are looking for a buy entry, you want the FVG or order block you identified to be below the 50% level of the last swing. If the bullish FVG is sitting in the premium, above the middle of the range, the probability of the setup working is lower because you would be buying at an already elevated price within the current structure. The logic behind premium and discount is that the market naturally tends toward equilibrium. After a bullish move that pushes price into the premium, there is a natural tendency for price to return to the discount before continuing higher. Buying in the discount and selling in the premium means you are always trading in the direction of the market's natural return to balance, not against it. This concept alone eliminates a good portion of low probability entries because it prevents you from buying near the top of a range and selling near the bottom. When you combine premium and discount with FVG and order block analysis, the process looks like this. You identify the trend on the higher time frame, you mark the last swing range, you calculate the 50% level, and then you look for the FVG or order block that is sitting in the discount zone if the bias is bullish, or in the premium zone if the bias is bearish. When you find one, you wait for price to return to that zone, wait for the lower time frame structural confirmation, and enter. That process, repeated consistently, is what produces positive results over time. Let's talk about trade management now, because finding the right setup means nothing if you do not know where to put your stop and where to take profit. In SMC, the stop goes below the order block when you are long, specifically below the low of the bullish order block with a small buffer. That buffer absorbs normal price fluctuations without triggering the stop prematurely. If price closes below the order block with a bearish candle, the institutional support zone has been broken and the setup is invalidated. Keeping the stop at that level ensures you are out of the trade the moment the analysis is no longer valid. A common mistake in SMC stop management is placing the stop too tight, right at the low of the order block with no buffer at all. What happens in those cases is that price comes back, dips slightly below the order block low to sweep the buy stop sitting there, and then reverses upward. That move is intentional. The market goes after the stops below the order block before continuing higher. If your stop is exactly at the low with no buffer, you get stopped out on that sweep and miss the trade that was correct. A small buffer below the order block low protects you from that type of stop hunt without meaningfully increasing your risk. For targets, SMC uses liquidity pools as reference. If you entered long in an order block in the discount, your first target is the last swing high, where the buy-side liquidity is sitting. That is the level where short sellers have their stops concentrated, and it is the level the market will try to reach to do the liquidity sweep. In some cases, you can use an open fair value gap above current price as an intermediate target, taking partial profits when price reaches that zone and letting the rest run toward the main liquidity pool. When there are multiple targets, a common approach is to close 50% of the position at the first target, usually the open FVG above, and move the stop to break even on the remaining position. That turns the trade into a zero risk position on the second half, while still letting you participate in the move toward the main target. When price reaches the main target, you close the rest. That scaled exit structure is what allows the final ratio of the trade to remain favorable even when price does not go straight to the second target. To make that calculation concrete, you enter long at 100 based on an order block in the discount. Your stop is at 97, 3 points below. Your first target is an open FVG above at 106, 6 points up. Your second target is the buy side liquidity at the last swing high at 112, 12 points up. You close 50% of the position at 106 with a 1.2 ratio on that portion. You move the stop on the remaining position to 100, your entry point. The second half of the position is now at zero risk. If price reaches 112, the ratio on that second half is 1.4. Combined, even if price only reaches 106 and reverses before hitting 112, you still come out positive on the full trade. That kind of exit structure is what makes the system sustainable over time, even with a win rate below 50%. That liquidity-based target structure is what gives SMC trades a naturally favorable risk-to-reward ratio when entries are made correctly. If you enter the bullish order block in the discount with the stop below the order block and the target at the liquidity pool above the last swing high, the ratio on the trade is going to be 1.3, 1.4, or more, depending on the distance between the entry zone and the pool. Even winning less than half of your trades, the system remains positive over time. That is the core reason SMC works as a risk management management framework. It is not that every setup is going to work. It is that when they do, the gain more than covers the losses from the ones that did not. Something a lot of people overlook when they start studying SMC is the importance of keeping a trade journal. Every setup you trade, whether it worked or not, needs to be documented. What was the confluence? What was the higher time frame bias? Was the FVG in the discount? Was there MSS confirmation? Did price reach the target or did it hit the stop? With that record, you can identify patterns in your wins and your mistakes. Maybe you find that your trades work significantly better when you wait for the full MSS versus entering on the first rejection candle, or that your best setups always have the FVG sitting inside the order block, never separated. That kind of data, pulled from your own trades, is what refines the system over time. Another concept worth covering before we wrap up is the optimal trade entry, or OTE. The OTE is a specific retracement level within the move that created the FVG, generally between 62% and 79% retracement of the impulse, corresponding to the 0.61 rate to 0.786 Fibonacci zone. That level indicates that price has retraced far enough to offer a favorable entry, but not so far that it suggests the original move is being reversed. When the FVG and the order block are sitting within the OTE zone of the impulsive move, the confluence is even stronger because you have three elements aligned at the same level: the FVG, the order block, and the optimal retracement level. In practice, to find the OTE, you draw the Fibonacci from the start to the end of the impulsive move that created the FVG. The zone between 0.618 and 0.786 is your OTE. If the order block and the FVG are inside that zone, you have a very high confluence setup. If they are outside it, if the order block is sitting at a 0.3 retracement, for example, the confluence level is lower. That does not mean the setup will not work, but a setup with OTE alignment will consistently carry higher probability. Before we close, none of these concepts works in isolation. The fair value gap alone is not a system. The order block alone is not a system. Liquidity alone is not a system. What creates a high probability setup is confluence. Multiple SMC elements overlapping at the same price level with the same structural alignment and the same time frame direction. When you have a bullish order block in the discount with an FVG inside that order block, sitting in the OTE zone of the impulsive move, price came down and swept the sell side liquidity below an equal low, there was a chotch on the lower time frame confirming the reversal, and the higher time frame is in an uptrend. That is the most complete setup SMC offers. Each element in isolation is just one piece of the analysis. The confluence is the full picture. It is also worth being honest about how long it takes to develop this skill. There is no shortcut. The first week of studying SMC will feel like everything makes sense in theory. The second week, when you go to the live chart, it will feel like nothing works. That is normal. The process of internalizing structure reading, liquidity zone identification, distinguishing strong FVGs from weak ones, and timing the confirmation is gradual. It is built